Imagine a world where you walk into a bank. You hand them your hard-earned savings, the money you worked for, the money you sacrificed for, and instead of paying you interest, instead of rewarding you for your discipline, they charge you a fee just to hold it. This sounds like a glitch. It sounds like a temporary error in the system, something that only happens during a crisis. But what if I told you that this is not a glitch? What if I told you this is the destination? We are moving toward a reality where money itself is a liability, where the act of saving is punished, and where the foundational laws of economics are being rewritten in real time. Most people think interest rates are high right now. They look at the Fed. They look at their mortgage rates, and they think things are tight. But they are looking at the wrong number. They are looking at the nominal rate, the number on the screen. They are ignoring the only thing that matters, the real rate. The return you get after inflation eats its share. And that number is diving. It is heading for the floor, and it is going to crash right through it. We are entering the age of permanent negative real yields. This isn't just about economics. This is about the destruction of the middle class, the distortion of every asset you own, and a fundamental shift in how power is distributed globally. The system is rigged to force you to speculate, to force you to gamble just to stay alive. Today, we are going to dismantle the lie. We are going to walk through the 5 structural shifts that guarantee rates will stay below zero for the rest of your life. This is the story of how the financial gravity was turned off, and what happens when everything starts to float away. But before we descend into this rabbit hole, you need to make a choice. Most people are happy consuming the headlines. They are happy being told everything is fine. If you are the kind of person who wants to see the machinery behind the curtain, if you want to understand the game so you don't get played by it, then you need to subscribe to this channel right now. Go ahead. Hit the like button if you want us to keep exposing these cracks in the system. Leave a comment, I am watching, so I know who is coming with me on this deep dive. Because once you see this, you cannot unsee it. Let's begin. To understand why your money is dying, we have to go back. We have to understand what an interest rate actually is. In a healthy, normal world, an interest rate is the price of time. If I give you my money today, I am sacrificing my ability to spend it. I am taking a risk that you might not pay me back. So you pay me interest. That is the reward for patience. It is the reward for delaying gratification. Civilization was built on this concept. The idea that saving for tomorrow is better than consuming today. But that contract is broken. It has been shattering in slow motion for 40 years. If you look at a chart of real interest rates since the 1980s, it looks like a ski slope. It goes down, and down, and down. Every time there is a crisis, rates drop. But when the crisis is over, they never quite go back to where they were. They peak a little lower each time, like a bouncing ball losing its energy. And now, the ball has stopped bouncing. It is rolling along the floor. Why? The mainstream media will tell you it's because of the central banks. They will tell you it's because the Fed is manipulating the market. And sure, the Fed is guilty. But the Fed is not the cause. The Fed is a symptom. The Fed is reacting to forces much bigger than a boardroom in Washington. There are tectonic plates moving beneath the global economy. Massive, heavy, structural shifts that no politician can stop. And these shifts have created a perfect storm. A vortex that sucks yields down into the abyss. We are going to break down these shifts one by one, because this is the roadmap for the next 20 years of your financial life. The first major shift is what we call the savings glut, or as I like to call it, the giant pool of money. Think about the world economy like a bathtub. The water in the tub is the available capital, the savings of the world, and the drain is the investment opportunities, the places where that money can go to be used. Factories, bridges, new technologies. For most of history, the water coming in and the water draining out were balanced. But starting in the late 90s, something changed. Something broke the faucet, and the water started pouring in faster than it could drain. This started with the Asian financial crisis. Countries like South Korea, Thailand, and eventually the massive giant, China. They learned a painful lesson. They learned that running out of cash is death. So they decided to never run out again. They started saving aggressively. They manipulated their currencies to run massive trade surpluses. They sold us cheap goods. We paid them in dollars. And instead of spending those dollars, they hoarded them. They built mountains of reserves, trillions of dollars, just sitting there, looking for a home. Then you have the oil exporters. Saudi Arabia, Russia, Norway. When oil prices boomed, they didn't just buy gold cars. They created sovereign wealth funds. Massive pools of capital that needed to be parked somewhere. So you have Asia saving. You have the Middle East saving. And then you have the dark horse. The global corporation. Companies like Apple, Microsoft, Alphabet. These aren't just companies anymore. They are nation-states. They are sitting on cash piles larger than the GDP of entire countries. They aren't building new factories fast enough to use all that cash. So they save it. Put all this together. Trillions from Asia. Trillions from oil. Trillions from tech. All of this money is waking up every morning screaming for a place to go. It creates a massive wave of demand for assets. Economics 101 tells us what happens next. When the supply of money is high, and the demand for loans is low, the price of money falls. The price of money is the interest rate. So you have this wall of cash crashing into the financial system, desperate to buy anything. Bonds, stocks, real estate. This buying pressure pushes asset prices up, and it crushes yields down. Imagine a game of musical chairs. But instead of removing a chair every round, you are adding 10 players. Everyone is fighting for a seat, and they are willing to pay for it. They are willing to accept lower and lower returns just to have a place to park their cash. This isn't a policy decision by the Fed. This is a structural imbalance in the global flow of capital. There is simply too much money, and not enough world to buy. And this glut isn't going away. China isn't going to stop saving overnight. Apple isn't going to spend its cash pile tomorrow. This pressure is constant. It is the gravity pulling us down. But if the savings glut is the water filling the tub, the next reason is the plug that stops it from draining. This brings us to the second structural shift. And this one is biological. It is inevitable. It is the demographic trap. We are getting old. The entire world is turning gray. And gray hair is deflationary. Think about the life cycle of a human being. When you are young, in your 20s and 30s, you are an engine of inflation. You buy a house. You buy a car. You buy diapers. You borrow money. You drive velocity in the economy. You are willing to pay interest because you are building your life. But then you hit 50. You hit 60. Your behavior changes. You stop borrowing. You start saving. You are terrified of running out of money in retirement. So you hoard. You become risk-averse. You take your money out of the risky growth engines, and you park it in safe, boring bonds. Now multiply that behavior by hundreds of millions of people. The baby boomer generation, the largest, wealthiest generation in human history, is moving into this hoarding phase all at once. Look at Japan. Japan is the ghost of our future. They aged before everyone else. And what happened to their interest rates? Zero. For 30 years. They have been stuck in a low-growth, low-rate trap since the 1990s. People looked at Japan and said, "Oh, that's just Japan. They are weird." No. They were just early. Europe is now Japan. Germany is aging rapidly. Italy is a retirement home. And China. China is aging faster than any society in history due to the one-child policy. They are getting old before they got rich. Even the United States is slowing down. When you have an aging population, two things happen that kill real rates. First, the labor force shrinks. Fewer workers means less growth potential. If the economy can't grow fast, it can't support high interest rates. It physically cannot pay them. Second, the demand for safe assets explodes. Retirees don't want crypto. They don't want volatile tech stocks. They want guaranteed income. They want bonds. So you have this massive demographic wave crashing into the bond market. Buying, buying, buying. Pushing yields down, down, down. This is not something the Fed can fix. Jerome Powell cannot print younger people. He cannot lower the average age of the population. This is baked into the cake. For the next 20 years. The pressure from demographics is entirely one way. It is a heavy blanket smothering inflation and smothering yields. But it gets darker. Because there is a paradox here. Usually, when people retire, they spend down their savings. They sell their assets. That should raise rates, right? But the wealthy are living longer. Much longer. And the wealthy don't spend down to zero. They preserve capital. They want to pass it on. So the capital doesn't re-enter the economy. It stays locked up, frozen in trust funds and bond portfolios. It becomes dead money. Zombie capital. Maintaining the price of assets but contributing nothing to real growth. This demographic shift creates a world where capital is abundant, but vitality is scarce. And in a world like that, capital has no leverage. It has to pay for the privilege of safety. This leads us directly into the third shift. The scarcity of safe assets. This sounds contradictory. I just told you there is a glut of savings. Too much money. So how can there be a scarcity of assets? Here is the catch. There is plenty of junk. There are plenty of risky companies. There is plenty of questionable real estate. But there is a massive shortage of pristine collateral. There is a shortage of assets that people believe are truly risk-free. The global financial system runs on collateral. It runs on trust. When banks lend to each other, they don't just shake hands. They demand collateral. Usually U.S. Treasuries or German bonds. But think about the world since 2008. The list of things we consider safe has gotten shorter and shorter. Mortgage-backed securities used to be AAA. Now they are toxic. Greek debt used to be safe. Then it wasn't. Corporate blue chips? Maybe. Until they get disrupted. So the entire world creates a funnel. All that savings I talked about. From China, from boomers, from oil. It tries to squeeze into a tiny, tiny door. The door marked U.S. Treasury bonds. Everyone wants the same insurance policy. When demand for insurance goes up, the cost of insurance goes up. In the bond market, high price means low yield. Investors are so terrified of the chaos in the world. Geopolitical wars, pandemics, trade wars, that they are willing to accept a negative return just to make sure their money is still there in the morning. It is the return of capital, not the return on capital. This is a fear premium. And we live in a world that is manufacturing fear at record levels. As long as the world feels unstable, the premium on safety will remain high, meaning the yield on safety will remain low. Look at the Eurozone. Look at Switzerland. There were years where you had to pay the Swiss government to lend the money for 10 years. Think about the insanity of that. You give them 1 million francs. 10 years later they give you back 900,000. And people lined up to do it. Why? Because losing a little bit is better than losing everything. Because the alternative was putting it in a bank that might fail. Or a currency that might collapse. This flight to safety is structural. Because the geopolitical order is fracturing. We are moving from a unipolar world led by the U.S. to a multipolar mess. Uncertainty is the new baseline. And in an uncertain world, the price of certainty becomes infinite. Real rates go negative because safety is the ultimate luxury good, and everyone is bidding for it. Now we have to look at the corporate engine. Shift number 4 is the deleveraging of the real economy. Or to put it simply, the refusal to invest. For 100 years, capitalism worked a certain way. Businesses borrowed money to build things. They borrowed to build factories, to dig mines, to develop new products. That demand for loans kept interest rates healthy. But something has shifted in the corporate psyche. We have moved from an economy of capital deepening, where we invest in heavy machinery and infrastructure, to an economy of capital light. Look at the biggest companies in the world today. Google, Facebook, Nvidia. They don't need massive loans to grow. Their assets are code. Their assets are intellectual property. They scale infinitely with very little marginal cost. They don't need to borrow billions to build a steel mill. So the corporate demand for debt is changing. But even the old-school companies are changing. Instead of investing in growth, what are they doing? They are engaging in financial engineering, stock buybacks, mergers and acquisitions. They are using their cash to eat themselves. Why? Because in a slow-growth world, it is safer to buy your own stock than to build a new factory. If you build a factory, you might fail. If you buy your own stock, the price goes up and the CEO gets a bonus. This reduces the demand for productive loans. If companies aren't fighting for capital to build the future, then the lenders have to lower their rates to entice them. But even at 0%, many companies aren't biting. This is what economists call pushing on a string. You can make money cheap, but you can't force people to do something productive with it. So the money stays trapped in the financial circuit, spinning around and around, inflating asset prices, but never touching the real economy, never creating the kind of rugged growth that drives real rates up. This is a structural stagnation, a reluctance to embrace the physical world. We prefer the digital. We prefer the financial. And the financial world doesn't need high interest rates. It thrives on low ones. And this brings us to the most painful shift of all. Shift number 5. The inequality loop. We cannot talk about the economy without talking about who holds the chips. We have reached levels of inequality not seen since the 1920s. And you might think, what does that have to do with interest rates? Everything. It has everything to do with it. Rich people and poor people use money differently. If you give $1,000 to a struggling family, what do? They spend it. Immediately. They buy food, fuel, clothes. That creates demand. That creates velocity. That creates inflation. But if you give $1 million to a billionaire, what do? They don't buy 1 million dinners. They don't buy 5,000 pairs of jeans. They save it. They invest it. The wealthy have a low marginal propensity to consume. As wealth concentrates at the very top, more and more of the world's money ends up in the hands of people who don't spend it. It ends up in the savings glut. The money is sucked out of the real economy and trapped in the asset markets. This kills demand for goods and services, which slows down growth, which forces central banks to lower rates to try to stimulate the economy. But lowering rates boosts asset prices, which makes the rich richer, which leads to even more saving, and even less spending. It is a doom loop, a spiral. The more they try to fix it with cheap money, the more they exacerbate the inequality that caused the problem in the first place. We are trapping ourselves in a low-rate, high-inequality prison. And nobody has the key, because the only way to break this loop is massive redistribution of wealth, and that is politically radioactive. So instead, we accept the low rates. We accept the negative real yields as the price of keeping the system from collapsing under the weight of its own unfairness. This inequality creates a permanent drag on the economy. It acts like a brake pedal that is pressed to the floor. And to keep the car moving, the central banks have to press the accelerator of low rates just as hard. The engine is screaming, but the car is barely moving. I know what you are thinking. But wait. Inflation is high right now. Doesn't that mean rates have to go up? This is the trap. This is where the mainstream narrative fails you. Yes. Nominal rates have gone up. But remember, we are talking about real rates. Nominal minus inflation. Why can't the central banks just raise rates higher than inflation and keep them there? Why can't they normalize? Because they are trapped by their own creation. Shift number 6. The sovereign debt ceiling. Governments are broke. Look at the U.S. national debt. 34 trillion and counting. Look at the debt-to-GDP ratios across the West. 100%. 120%. In Japan, 260%. When you have that much debt, you physically cannot afford positive real interest rates. Do the math. If the U.S. debt is 34 trillion, and the interest rate is 5%, that is $1.7 trillion a year just in interest payments. That is more than the entire defense budget. More than Social Security. It is unsustainable. It would bankrupt the government instantly. It would require massive tax hikes or massive spending cuts, both of which are political suicide. So what is the solution? Financial repression. This is a technical term, but it essentially means robbery. The government and the central bank conspire to keep interest rates below the rate of inflation. If inflation is 4%, they keep rates at 3%. That means every year, the real value of the debt shrinks by 1%. They are inflating away their debt at your expense. You, the saver, are paying off the government's debt through the erosion of your purchasing power. They need negative real rates. They require them to survive. It is the only mathematical way out of the debt trap without defaulting. And the U.S. government will never explicitly default. They will implicitly default. They will pay you back in dollars that are worth less than when you lent them. This is the policy. It is not an accident. They might talk tough about fighting inflation, but they will never raise rates high enough to truly kill it, because that would kill them. So the ceiling on rates is low, but the floor on inflation is rising. The gap between them is the negative real yield, and that gap is where your wealth goes to die. Let's pause for a second. Let's look at the picture we have painted. We have a savings glut flooding the world with cash. We have an aging population hoarding that cash. We have a shortage of safe places to put it. We have corporations refusing to invest in the real world. We have inequality killing consumer demand. And we have governments that are too indebted to allow rates to rise. Every single arrow points in the same direction. This is not a cycle. This is a secular trend. A trend that spans decades. So what does this mean for the future? What does the world look like when negative real yields are the permanent state of affairs? First, welcome to the era of the everything bubble. When you can't get a yield from a bank account, when you can't get a return from a safe bond, you are forced to go further out on the risk curve. You have to buy stocks. You have to buy real estate. You have to buy crypto. You have to buy art, watches, vintage cars. Money flows into everything except productive investment. Asset prices detach from reality. The price-to-earnings ratios go to the moon. House prices become completely disconnected from wages. Because people aren't buying a house to live in. They are buying a store of value. They are buying a life raft. This creates a society of haves and have-nots. If you own assets, you feel like a genius. Your net worth goes up every year. But if you don't own assets, if you work for a wage, you are running on a treadmill that is getting faster and faster. You can never catch up, because the price of entry keeps rising faster than your paycheck. This destroys social mobility. It creates a feudal system. lords of capital, and serfs of labor. And the scariest part? These bubbles become too big to fail. If the stock market crashes, it wipes out the pensions of the boomers. It wipes out the tax revenue of the government. So the central bank has to step in. They have to print money to prop it up, which creates more liquidity, which lowers yields further, which inflates the bubble more. It is a one-way ratchet. Volatility is suppressed until it isn't. Second, risk is mispriced. In a normal world, high risk should mean high reward. Low risk means low reward. But in a world of negative real rates, investors are starving. They are desperate. They will lend money to zombie companies for pennies. They will buy junk bonds that yield almost nothing. This keeps bad companies alive. Companies that should have gone bankrupt years ago. They survive because debt is free. This is bad for the economy. It's like a forest that never has a fire. The dead wood piles up, choking off the new growth. Productivity stalls. Innovation slows down, because the creative destruction of capitalism is turned off. We end up with a zombie economy. Walking dead. Slow. Lethargic. Fragile. But alive. Supported by the life support machine of cheap money. Third, the currency wars. If every country wants to export its way out of trouble, and every country wants to keep its rates low, we enter a race to the bottom. Currencies become weapons. Countries will fight to keep their currency cheap to help their exporters. But they will also fight to keep their currency strong enough to attract capital. It is a chaotic oscillation. But the end game for fiat currency in a negative rate world is a loss of trust. If the dollar guarantees you a loss of purchasing power, eventually, people look for an exit. This is the bullish case for gold. This is the bullish case for Bitcoin. Not because they are perfect, but because they are the anti-bonds. They are assets that cannot be diluted by a central banker with a keyboard. In a world of negative real yields, zero yield is a hero. Gold yields 0%. But if bonds yield negative 2% in real terms, 0% is the winner. The rock beats the paper. We will see a structural shift away from government debt as the primary reserve asset, and a move toward hard assets, things that are finite, things that are real. Let's talk about the psychological toll. What does this do to your mind? It creates a culture of anxiety, a culture of gambling. When saving is for losers, speculation becomes a survival strategy. You see it already. The rise of retail trading, the obsession with 100x gains, the YOLO economy. This isn't just greed. This is desperation. People intuitively know that the old path is broken. They know that save 10% of your income and put it in the bank is a lie. So they swing for the fences, because striking out feels the same as standing still. You are losing either way. This changes the character of a nation. It erodes the values of patience, hard work, and long-term planning, and replaces them with short-termism and hype. We are becoming a casino civilization, because the house has rigged the slot machines. Let's drill deeper into the mechanism of the endgame. Because you might be thinking, can't this just go on forever? Japan has done it for 30 years. Japan had a luxury we don't have. Japan had a global economy that was still growing to sell into. Japan could export its excess savings to the US and Europe. But when the whole world becomes Japan, there is no one left to export to. We are looking at a synchronized global stagnation, planetary Japanification, and there is a physical limit. At some point, the trust snaps. This is the nightmare scenario. The bond vigilantes return. Imagine a moment where the market simply refuses to buy the debt. They say, no, we will not accept a guaranteed loss. We want a real return. If that happens, yields spike. Interest rates explode upward. Not because the Fed wants them to, but because the market forces them to. If rates spike on $34 trillion of debt, the system breaks immediately. The government becomes insolvent. The banking system collapses. So the central banks have to make a final choice. Yield curve control. They will print infinite money to buy the bonds themselves, to artificially pin the rates down, to keep the illusion alive. But when they do that, when they become the only buyer, the currency collapses. Hyperinflation, or at least very high, sustained, double-digit inflation. This is the ultimate way to get negative real rates. Rates are pinned at 3%. Inflation goes to 15%. Real rate, negative 12%. Your wealth is cut in half in 6 years. This is the reset. This is how the debt is cleared, not by paying it back, but by incinerating the value of the currency it is denominated in. It is a soft default, and it is the path of least resistance for every politician in the world. Because it's confusing, it's complex, and they can blame it on greedy corporations, or supply chains, or foreign wars. They will never admit it is the math of their own debt requiring the destruction of your money. What can you do? I am not a financial advisor, and this is not financial advice. But you have to think strategically. You have to stop thinking in terms of nominal dollars, and start thinking in terms of purchasing power. You have to own scarcity. If they can print it, don't own it. If they can dilute it, don't trust it. You need assets that benefit from the debasement of currency. Productive land, commodities, strong businesses with pricing power. And yes, maybe some of the anti-bonds we talked about. You need to get off the treadmill. You need to stop playing the game by the rules of the 1980s. Those rules are dead. The era of high yields on safe cash is over. The risk-free rate is now return-free risk. Let's look at the tech angle again, because there is a counterforce. Technology is deflationary. Robotics, automation. These things lower the cost of goods. They make things cheaper. In a normal world, this would be amazing. It would mean your dollar buys more. But in our debt-saturated world, deflation is the enemy of the state. Deflation increases the real value of debt. If prices fall, it becomes harder to pay back the loan you took out yesterday. So the more technology pushes prices down, the harder the central banks have to print to push prices up. It is a war between the deflationary power of technology and the inflationary imperative of the debt system, and you are caught in the crossfire. The central banks are terrified of AI-driven deflation. They will fight it with a tsunami of liquidity, which means the asset bubbles will get bigger, and the volatility will get wilder. We are entering a period of extreme turbulence. The smooth sailing is over. The seatbelt sign is on. This leads us to the geopolitical implications. Shift number 7? No, this is just the reality of the landscape. The demise of the dollar hegemony. For 80 years, the US dollar was the king, because the US Treasury bond was the gold standard of safety. But if the US Treasury bond guarantees a loss, why hold it? Why should China hold it? Why should Saudi Arabia hold it? They are starting to ask this question. We are seeing the rise of the BRICS nations, exploring alternative payment systems, exploring commodity-backed currencies. They want to escape the trap of negative real yields in dollars. They want to price their oil and their goods in something that holds value. This is a slow process. It won't happen overnight. But the trend is clear. The demand for US debt from foreigners is drying up. Who is replacing them? The Fed. Domestic institutions forced by regulation to buy. And you. Through your pension fund. The exorbitant privilege of the United States is eroding. The ability to print money and have the world accept it is fading. This means the US will have to print even more to cover its own deficits, deepening the negative rate cycle. It is an Ouroboros, a snake eating its own tail. Let's summarize the mechanism. Too much savings, the glut. Too much fear, the safe asset shortage. Too many old people, demographics. Too much debt, the sovereign trap. Too much inequality, the velocity killer. These 5 fingers form a fist, and that fist is crushing the real yield. This is not a conspiracy theory. This is accounting. It is the inevitable result of the choices we have made for 40 years. We chose debt over savings. We chose bailouts over bankruptcy. We chose asset prices over wages. And now the bill is due. But the bill won't be paid in a lump sum. It will be paid in a slow, grinding expropriation of your wealth through negative real rates. Every day you hold cash, you are bleeding. Every day you play it safe, you are falling behind. This is the new gravity. Is there any hope? Is there any light at the end of this tunnel? The hope lies in understanding. The hope lies in adaptation. The system is broken for the passive observer, but it is full of opportunity for the active participant. Volatility creates opportunity. Dislocation creates bargains. If you understand why rates are negative, you can position yourself to benefit from the bubbles rather than being crushed by them. You can choose to opt out of the losing game. You can educate yourself. You can build skills that are scarce. Because while capital is abundant and cheap, competence is rare and expensive. In a world of fake money, real value becomes the only currency that matters. Invest in yourself. Invest in your ability to create, to solve problems, to build things that people actually need. Because no central bank can print competence. No government can inflate away your skill set. That is your true hedge. That is your true, real yield. We are standing on the edge of a great transition. The old financial order is dying. A new one is struggling to be born. It will be chaotic. It will be scary. But it will also be the greatest transfer of wealth in history. The question is, will you be on the receiving end or the donating end? Will you be the one holding the melting ice cube of cash? Or will you be the one owning the water? The choice is yours. But you have to make it now. You cannot wait for the headlines to tell you what to do. By then, it will be too late. The gates will be closed. The capital controls will be in place. And the negative rates will be locking you in. This brings us to the final realization. The philosophical shift you need to make. For generations, we were taught that money is a store of value. That is no longer true. Money is now a flow. It is a hot potato. It is a medium of exchange, yes. But it is a terrible store of value. You have to treat money like energy. Use it. Convert it. Transform it into something else. Don't store it in a battery that leaks. Store it in land, in business, in knowledge, in gold, in code. The saver is the victim of the 21st century. The owner is the victor. It is a harsh truth. It feels unfair. It feels wrong. But arguing with reality is a losing strategy. The map has changed. You can keep trying to navigate using the old map. The map where 5% interest was normal. The map where you could save your way to riches. And you will get lost. Or you can look at the territory as it is. Rugged. Dangerous. But navigable if you keep your eyes open. Why did I tell you all this? Why did we go through the savings glut, the demographics, the debt trap? Because I want you to be prepared. I don't want you to wake up in 10 years. Look at your bank account. And wonder why you can't afford the life you were promised. I want you to know exactly why. And I want you to have done something about it. The battle for your financial future is happening right now. It is happening in the bond market. It is happening in the central banks. It is happening in the deficits. And most people are asleep at the wheel. They are distracted by the noise, by the politics, by the culture wars. Meanwhile, The economic ground is sinking beneath their feet. Do not be distracted. Watch the rates. Watch the debt. Watch the flows. Follow the money. Because the money is running away from the risk-free rate. And it is looking for a home. Make sure you build a home for it. We have covered the 5 demand shifts. We have looked into the abyss of the sovereign debt trap. We have exposed the illusion of the safe asset. The argument is simple. Negative real yields are not an accident. They are the design. They are the only way the math works. The system requires your sacrifice to sustain itself. Do not volunteer. I want you to take a moment. Turn off the noise of the day and really think about what safety means to you. Is safety a number on a screen that is guaranteed to lose value? Or is safety the ownership of something real? Does the idea of risk-free actually expose you to the biggest risk of all, the slow, invisible theft of your time and labor? Ask yourself, if the game is rigged against the saver, why are you still playing by the saver's rules? Think about that. Really think about it. Thank you for watching. Thank you for giving me your most valuable asset, your time. If you found value in this, if it sparked a thought, if it shifted your perspective even a little bit, then we have done our job. We will be back with more. We will keep digging. We will keep analyzing. We will keep watching the horizon. Until then, stay curious, stay skeptical, and I will see you in the next video.